Hello, everyone. Welcome to the webinar. I'm Matt Cropp, and I'm the co-executive director of the Vermont Employee Ownership Center. And I'm here with Lynne Silva.
Hello, welcome everybody. Really glad you could join us today.
So this presentation is a bit of an experiment. So every year we do a number of sessions around the state of Vermont, presenting kind of an overview of the various options and kind of as a starting point for considering ownership succession. And so we've condensed down that presentation into 1 hour, and we're going to run through kind of four sort of some of the general considerations, and then 4 key options that for a business owner are definitely worth considering as you think about what your exit looks like. So we'll be looking at sale to an outsider, sale to manager, sale to family, and then sale to the broader group of employees. So as we go through it, we'd invite you to submit questions through the webinar interface, and we can kind of keep an eye on those and answer them kind of as we go. So if there's something about, say, sale to family you want to know, we can kind of answer that before we move on to the next category. So any other housekeeping measures you want to hit on, Lynn, before we get into the slides?
I think we're ready to roll.
Great. All right, so we will share the slides here. All right. So as we introduced the presenters and gave you the basic overview of the objectives that we have for the day. So we want you to kind of come away with this with some ideas about the various pathways and empower you to begin your exit planning now. So we'll start with the transition overview. So Lynn, you want to take it away?
Yeah, everyone will move on from ownership at some point. If there's some planning, you have create your own exit strategy yourself.
Oh, so
we're still there.
Here. Hang on 1 second. Share screen. There we go. Yep,
okay. In this presentation, we'll be talking about selling established businesses. The people can also sell certain startup businesses. You can also sell pure intellectual property, such as patents that don't have a business. But we're focusing on established businesses and the issues around them today. Okay. Why plan? Well, it's going to change how you operate before you transition your ownership. You'll find with good planning that certain things will be more important for you to put your time into and others will not. If you have a game plan for the transition in mind, when the time comes, it's going to save you a lot of money and time when you actually do move into the transition. Another good reason to plan is that can often increase the selling price of your company, and we'll talk about that a little later in the presentation. And it may reduce your tax liabilities on the sale. Common question, do you have to pay taxes on your proceeds from the sale of your business? Oh, yes. And there are a lot of ways to kind of dampen how much of the tax hit you'll see, but generally you'll need some good planning around that. A good time to start thinking about the transition is perhaps 2 years before you'd like to start putting it into motion. Granted, there are people who have something arise, some circumstance, and they'll just have to make it happen immediately. But if you have a good 2 years, that will give you time to do the research you need, to talk to the people you need, to think this through, while at the same time you're normally running your business full time. So you really need to pace out this work. When is the right time to transfer ownership? Two big considerations. Is the company ready? And are you ready, the owner? Okay, just let's go back one slide. Yep. For the company being ready, the first thing we generally look at is not the value of the company, is the company inherently saleable? Not all companies can be sold or their ownership transferred. There are reasons for that. One of the biggest challenges with smaller companies is that the company is very much about the owner who is operating it. So the goal around saleability is to get your company to the place where somebody could run it, somebody who's not you, someone else. So this is where a little planning in advance can help if you need to shift some key responsibilities. Those are often in sales and customer relationships. Those are some of the tougher ones to transfer. They can be based on very personal relationships. If you're managing the finances, honestly, that's easier to hire someone in or transfer. That's pretty basic. But anyway, cross-training staff is something you may think about doing earlier. Other saleability issues are about the industry. How's your industry doing? Is it on the upswing or down? Certain industries are dying out. That company is not going to be saleable for much longer or if at all.
A great example of that is thinking about like bookstores maybe 20 years ago versus now.
Or video stores. Mm-hmm. They're entirely unsaleable and were over 10 years ago. When you're looking at saleability, does the company have growth potential? Every wise buyer wants to buy a company that could continue to grow. In terms of risk management, every buyer would look at what's the competition doing to you? Are you facing new competitors? Sometimes someone sets up right next door and essentially they are going to put you out of business. One big issue to look at, and this is something that you may be able to moderate a bit if you plan, is there a customer concentration? A customer concentration means when you have a high percentage of your sales going to a single customer or maybe a few key customers. Obviously the risk there is if you lose that customer, what happens to the company? What's the cutoff on that? It depends on who you're talking to. Generally, about 15% of top line sales to any single customer will start to raise concerns. It may not be bankable at 20-25% of sales to a single customer. Some of the acquirers out there, the professional acquirers like private equity groups, will categorically not look at the business. What do you do if you have a customer concentration? If you plan, you're going to need to redirect some sales efforts to intentionally lower that concentration, preferably by building up sales to other entities. In addition, can you get that key customer under a long-term contract that's transferable? These are just very practical ways to deal with things that will gum up the works if you try to transfer ownership without something done to address them. Other key things that we look at, saleability. If you have customer contracts, are they transferable to a new owner? That's a review with your attorney. There's clauses you can put in to all your contracts moving forward so they can transfer upon sale of the company. And then the basic housekeeping things. Are your financial records in good order? Get things cleaned up and ready to roll. And then the big one, is the business profitable? This is something we'll swing back to. When a business transfers ownership, unless it's a sale all cash, occasionally you'll have someone come in who can do that. But generally, there's financing involved, whether it's outside financing with a bank or you as the seller are holding it. How does that debt service get paid? It gets paid out of the ongoing profits of the business. So there has to be some cash flow in that business in order to basically support its own sale. Swinging back to on the personal side, are you as the owner ready now? If your company may be ready, are you ready? And it's important to acknowledge selling a company you've built is one of life's major transitions and major decisions. It's a huge emotional step. Many of the folks I've been doing this for over 15 years. It takes them several years to get to the point where they really know they're ready to make the change. Something I wanted to share here as the owner. Generally, when you sell your company, you're required to sign a non-compete agreement with the buyer of your company. These agreements will generally prevent you from competing against them within a certain geography for several years. So when you sell your company, it's not like you can bounce back in and start another one just like it in the same area. You have to be ready to change and move on to something else if you're going to continue working. Maybe move to the family member. So I don't know if any of you have the possibility of transferring ownership to a family member. There are a couple unique issues that usually pop up there. The readiness of that person to take on responsibility. It can be a concern. Many families, if they're looking to transfer the company to the younger generation, they do insist that generation work somewhere else and then come back just to get some experience. And then the other issue is if you have, say, one child taking over the business but have other children, how do you sort out an equitable transfer of wealth to your children? And that's where a good attorney and accountant may come in as well to help you with the estate planning side of that. Okay, we can move on. So when you're considering your transition, most owners think about how can your employees and customers be well cared for after you're gone? Can you protect the legacy you've built, and your place in the community? And one of the important issues is, what does the company itself require for success in the next generation of ownership? Key thing, if your company's growing quickly, what does it need for skills, especially new skill sets to be brought in? And what does it need for capital? That can be one of the more challenging situations when you're on a quick ride up. How do you set up circumstances where the next owner or owners can really provide what the company needs? Okay, we're moving now into a few slides about business valuation. When you're thinking about exit planning, a business valuation, even a very rough one, is a key element of exit planning. It's important to understand roughly how much your company may bring you. First question most owners have for me is, will this get me enough to retire or move on to what they want to do next? That's a really good question. Many owners find the business valuation will really dictate the timing of their sale. If the value of the
on building value.
Yeah. Okay. So good valuation. First, you start with whether the business is saleable. No point in running the numbers if it inherently cannot be sold. An objective sense of the likely value range. Business valuation is as much art as science, and not to be flip here, but the value of a business is what somebody is willing and able to pay for it. So You'll have valuators, legitimate valuators can come up with very different ranges for the value of your business. When you get on if you go on the market, you can get offers all over the place with terms all over the place. It's important to know. That said, a valuation will get you in the ballpark of what may be possible and may be financeable, because that's if outside lenders involved, they certainly have their own standards for what they're willing to, where they're willing to go with the value. So basically, the ultimate value is in the perspective of the acquirer. A valuation will help you understand what drives and detracts from the business value. That's really important because that helps you focus on moving the business forward. If you have business lines that are really not bringing you much margin, you may want to back off from them if they're not doing anything else for you. Focus on what's bringing you money. If retail companies, a lot of the owners think, okay, I'll just add inventory, the company will be worth more. Oh no, you want to be churning inventory. Too much inventory can really slow a sale. The valuation will also identify the viable exit pathways for your company. We'll be talking about the pathways a little down the road here, but not every pathway will be viable for every company. For example, a very small business probably will be of no interest to a financial buyer, such as a private equity group. Very small businesses, their transition and ownership is typically, if they go outside, to an individual small enough for one person to buy it, or if to an insider, then to one or more employees. As companies grow up and scale, they may be of interest to strategic acquirers. Those are companies in the industry who are familiar with your product or your service. Even if you're too small to be brought on as a platform company, you may still be of interest to strategic acquirers as an add-on to one of their platform companies. So the game will shift depending on the scale of the company and how you're operating. Valuation, there are no numbers today. Here's what we're going to share. Most owners overestimate the selling value. This is why you need a valuation. It's human nature. Blood, sweat, and tears. That's how everybody estimates it. But get someone outside to help narrow that in a bit. You've probably seen references online to valuation multiples. This is how many times they multiply your normalized earnings to get to selling price. And by the way, you also see cap rates. They're just mathematically the inverse of a multiple. Multiples and cap rates, a lot of range for any particular company you'll find. Important thing to realize, valuation multiples rise as the company's earnings and sales increase. So you're not using a 10 multiple, which you probably see online for $1 billion company, on a company that's earning $200,000 a year. The multiples are going to be much lower. The multiples will swing though. If you have a rapidly growing company with continuing great potential to grow, that's probably going to sell at relatively high end of the valuation range. Okay, so we'll move on. Okay, value drivers, other things that will make your company worth more. Well-trained staff, especially, can function well without you there, if that's your game plan to leave. An established and transferable customer base, everything you can do to make sure those customers would stay on. A history of revenue growth, that's really, really appealing. Consistent profitability. Some companies and industries just tend to swing a lot from one year to the next. You can be saleable, but you may probably see softer multiples than a company that's pretty consistently profitable. Good business processes, including good financial records, and just well-known, positive company image. Not on this slide, but some value detractors would be. These are drivers. What would decrease value? Customer concentration, already talked about, that's a big one. Retail, I can mention. Excess industry is just, that's not going to help the sale at all. Okay, so now we're going to move into the actual transition pathways.
So before we get
Yep,
into
yep.
that, let's just check to see, we'll check real quick, see if anyone's got questions
here.
at this point on the valuation side. So feel free to submit them again through the platform. Looks like we do not have any yet, so we'll continue along. But again, if you have any as they come up, throw them in, and we'll be checking periodically.
Yeah. We'll also take all questions at the end too. If you have any that you haven't gotten to us, we'll have some time at the end.
All right, so transition pathways.
Transition pathways. Okay. Here they are. An outside sale to a third party, an individual, which is generally for smaller companies, a strategic acquirer, that's somebody in your industry or affiliated with it, or a financial acquirer, that's somebody like a private equity group. Second option, a sale or gifting, that's often part of estate planning to family members. Third one, management buyout or a sale to key employees. That's kind of dependent on this. A larger company, it's called a management buyout. You usually have a second line of management. Smaller companies, they really don't. It's just, one or two key employees. And then the fourth one is sale to all the employees through a defined structure like an ESOP or a worker cooperative. Okay. One note is that many owners, when they're planning, will keep more than one exit pathway in mind. When it's time to move forward, if one option doesn't play out, then you can swing over to another. For example, sometimes the staff are not interested in an internal sale, in which case you'll need to look at an external sale. And then vice versa, sometimes an external sale is just not working out, and it's time to go back and see if a sale to all your staff will be successful. Okay. There's a few things that all four of these pathways have in common. The first is that the process is lengthy. Budget at least a year of your time. You can't do this full time. You need to run the business. There are a lot of decisions. There's a lot of research that have to be handled over. It's going to take a good year. There are no guarantees in life. A particular transaction may or may not get to closing. Don't count on it until it does. There's no guarantee that any business will successfully transition ownership. That's why when you have a good opportunity in front of you, don't blow it. Take it seriously. Tend it. Try to make sure that it comes to be. There are a lot of steps in this process. It takes a lot of tending. And the other, that it's an emotionally stressful time and a major life transition. It's a good time for whatever you do to take care of yourself, just do more of it. Okay. Common issues. If you're looking for a sale, it's not just the price, it's the terms that may define whether or not this is a favorable deal for you or not. You'll probably have heard what some of your competitors sold for, this and that. Whenever you have partial information on a sale, keep in mind you're missing information. For example, what was included in the sale and what was excluded. When they're talking about that dollar amount that they got for the sale, was working capital included? That would be extra cash or accounts receivable. Was a debt transferred to the buyer? So just when you hear feedback from other people about what they sold for, listen with, just have a grain of salt, because it may not be the complete situation. So terms of a sale may include earnouts, that's deferred compensation, based upon the buyer being able to achieve certain things with the business. Escrows, where you hold back some of the funds until certain things are achieved. Seller financing, by the way, is very common right now. Expect to hold some of the deal as a seller note. It's very rare to not have any seller financing. Tax advantaging strategies. If you're set up as a corporation, one of the first considerations is stock sale versus asset sale. If you do go an asset sale, which you'll have to if you're not a corporation to begin with, how you allocate that purchase price can have a big impact on how much you pay in tax. All good questions for a really good accountant. Okay. And then another term, you may have the option to retain or roll over equity in the business. You may retain partial minority interest after the sale. Okay. The other common thing to all these pathways, when it works, it's great for everyone. Everybody's pretty happy. You get bragging rights when you sell your business. You know, that's not only did you run it, but you set up the pathway for it to carry on to the next owners. It's a great thing. Okay, third-party sales, one of the options here. Often bring the highest selling price, may offer opportunities to tax advantage some or all the sale proceeds, and often include terms such as earnouts or seller financing that will bind you for several years. That's very, very common. Okay. Sales or gifts to the family. You know, it's great to keep it in the family. You have another generation willing to come on. Sometimes you can also choose to be the banker. Just a little warning here, the IRS issues around these sales and the setting of fair market value are very complex. You need a very experienced accountant working with you on this. Okay.
And this is one of those few ones where you see, like, as you mentioned, the gifting piece.
The gifting, yes, you can do that.
So
yeah.
The awareness of what are the limits per year, and oftentimes if you're planning in advance, you're like, oh, you need like 10 or 15 years of giving the maximum gift to sort of like lay the groundwork.
Yes, so that you can fully tax advantage the gifting you're doing. So it helps to plan ahead. Okay, with sales to family, there's often the tension between how much you take for yourself and your work and how much you leave in for the next generation. Often tension on the timing too. Are you ready to move on? You may not be, and yet the next generation is really ready to take over. That's a bit of a dance, but it can be sorted out. The transaction structure with family sales often uses some financing and some wealth transfer, like Matt was just sharing here. Sales to key employees. This is whether it's a manager buyout or a few key. The owner might not receive the highest price. That's because the staff generally don't have enough cash for the initial down payment for bank financing. The workarounds are usually have them start buying in over several years. And once they have enough equity, then they can finance the rest with a bank, or have some seller financing or a mix of both. These sales are very, very common with smaller businesses, and they work well if you start thinking about this a few years in advance, largely because of the financing issue. So professional practices, which Matt will talk about a little more, engineering and accounting, this is normally how they move on. They bring in younger partners to buy out the retiring partners. Another aspect of selling to key employees is when you're planning, this may impact your hiring, because you're essentially hiring in your own successor or successors. So talking to potential hires about whether they might have interest in ownership down the road, that's an important piece to throw in here. Okay, I think we're about ready to segue on to Matt here.
Hi folks, so I was about at this point in the presentation that we lost some of our internet stability, so I figured I would just kind of quickly reshoot it and tack it on to the end and send it out to folks who attended the presentation. So yeah, so at the Vermont Employee Ownership Center, we treat broad-based employee ownership as our kind of primary focus. So for us, that is a form of ownership that provides a path to co-ownership to all full-time equivalent employees. Now, there's companies that can include part-timers or other things, but that's kind of the baseline. So everyone, when they come to work for a company, they're not owners immediately necessarily, but there's a path to becoming a co-owner in the future. And the two main structures we work with are the Employee Stock Ownership Plan, or ESOP, and Worker Cooperative. So an ESOP is a company that's owned by the retirement plan with the employees as beneficiaries of that plan. Where the Worker Cooperative is a more direct form of ownership, where each employee buys one share which gives them kind of certain rights and both governance and profit. So we'll go a little bit kind of into sort of what each of these mechanisms looks like and kind of how financing works if you're looking to exit to the broader group of employees. So for an ESOP, there's a few key considerations. The first is scale. So our rule of thumb is about 20 employees, 3 million in enterprise value. That's not a hard number. There are certain situations where you could go lower on either side. But there's certain considerations, particularly around the cost of setup, that kind of influence whether or not an ESOP is really feasible. So a key piece, of course, is that the initial setup can cost upwards of $150,000, including things, it's a highly regulated transaction, lawyers, valuators, all of this, all of the trustees, all of these players that are needed to really make sure that this happens within kind of in a legally acceptable way. Now, there's a number of tax benefits that we'll talk about that can offset that, but under a certain scale, it's unlikely that they will. So that's why we kind of tend to set that as the number. A second consideration for ESOP is in terms of the transaction, you can sell any percentage of the company sort of gradually or all at once. Now, if you sell more than 30%, and it's a C corporation, there's some tax benefits around that. But there's some companies that will even go pay as you go. So each year they decide, all right, we'll make some contribution to this, the ESOP plan, and that will be used to buy shares, and gradually the employee ownership will increase of the company as some of the selling owners' chips are essentially bought off the table. And then because it's this more indirect form of ownership through the retirement plan, employee involvement is more optional in the ESOP case than the co-op case. So because the employees are receiving ownership as a benefit, right, it's kind of a pre-tax retirement contribution, rather than having to sort of dip into their own pocket and put some money on the bulkhead, they don't necessarily need to be involved in the sale process. Like many ESOPs, the employees aren't aware that the broad group isn't aware that it's even happening until, the ink is dry and all the I's are dotted and T's are crossed. That said, the studies of employee-owned companies really show that combining participatory management with the ESOP and kind of higher employee involvement really does lead to some significant productivity improvements. So there's definitely reasons to involve folks, but it's not kind of it's not a necessity as it is in the worker co-op, which we'll see in a minute. The other key thing with ESOPs is because they're sort of embedded in retirement law, there's some tax benefits that are worth understanding a little bit. So for the C corporation, you have if you're a C corporation that's being sold, if at least 30% is sold, the seller can defer capital gains, which is called the 1042 rollover. And basically what that means is if they take the proceeds of the sale and they reinvest it in qualified replacement property, which is the debt or equity of US operating companies, then as long as that QRP is held, the capital gains do not need to be paid, they're deferred. And if that qualified replacement property passes into your estate after the seller's death, then the capital gains are wiped out completely. So especially for older business owners who are really thinking about this as part of their estate planning, that can be a powerful tool in certain situations. The S corporation ESOP you can't do the 1042 rollover, although there is some advocacy talk about kind of making it so you can. But one of the key benefits is that it can operate income tax free if it's 100% ESOP owned, because the S corporation is a pass-through entity and the ESOP is a tax qualified retirement trust. The tax is paid when individual ESOP beneficiaries receive their benefit upon retirement or upon withdrawal from the plan. But from the company's perspective, it's operating tax-free, and that can sort of free up some cash for managing repurchase obligation, paying down the debt, etc. And then in all cases, kind of one of the other benefits is the ability to make debt payments with pre-tax retirement contribution money. So this means kind of you're essentially able to buy out sort of the portion that's leveraged more efficiently because you're able to sort of do it with that sort of pre-tax retirement contribution. And so it kind of has a bit of a multiplier effect on the debt capacity. So the worker co-op is what we tend to see in Vermont for smaller companies. Not only small companies, there's companies with thousands of employees that have this model, so it's workable across lots of scales, but particularly for companies that are too small for ESOPs. In Vermont, that tends to be the niche where we see a lot of kind of interest and activity on the worker co-op side. So really, like any company, 3+ employees, can work at a large scale. Most in Vermont are in that 5 to 30 employee range. The largest is the New School of Montpelier, which has upwards of 50 employees. Unlike the ESOP, there's a direct employee buy-in. Employee owners each hold one share that gives them a vote for the board and a share of profit. The share price is not tied to the valuation, but it's kind of this interesting rule of thumb around the question of on the one hand you want it to be low enough that it's accessible to the low end of the wage scale, but on the other hand you want to be high enough that it feels like real skin in the game. So we see a range in Vermont of between 500 and 15,000, but it's usually a small percentage of the total sale price. But because people are putting in some of their own money, unlike the ESOP, employees do need to be directly involved in the sale process. So that usually looks like there's presentation, ask if the employees are interested, and once they kind of understand what the model is, if the answer is yes, then there's a steering committee formed, they do some research, they talk to capital providers, they come up, maybe talk to the SBDC, come up with a proposal for the buyout. And then there's the question of the transaction. So generally, a worker co-op does require 100% sale. Although a majority sale is possible. There is an entity that's kind of like a hybrid of a co-op and an LLC called a mutual benefit enterprise in Vermont and some other states. It's called a limited cooperative association. But up to 49% of the company can be owned kind of as you would with an LLC, and then as long as 51% of the company and voting power is in the hands of kind of a cooperative structure. So if there's a situation, that can be used for something like professional firms that require a certain percentage of ownership to be in the hands of licensed professionals. So you could set aside a portion of that ownership to only be held by professionals, and the rest, kind of everyone can kind of be an equal owner of the cooperative portion of the firm. So that's kind of one example. But usually with worker co-ops, it's 0 to 100 with a seller's note or something like that. So when it comes to financing, the ESOP, it's usually there's some seller financing, as Lynn mentioned, with other forms as well, right? So in both of these cases, oftentimes financial institutions, if they're lending, want to see some skin in the game on the part of the selling owner, as a vote of confidence in the future of the business after they move on. And as subordinated capital that sort of is first loss before their loans might be lost. So then bank financing, banks do have a fair amount of experience with ESOPs. A number have ESOP practices, so it's not an unknown. There's thousands of them in the United States. So conventional lenders are have familiarity with the structure and working with it and all of that. And then there are SBA and USDA loan guarantees specifically tailored towards this. The SBA ones have been in the past unwieldy, but the Main Street Employee Ownership Act was passed last year and is designed to make it a lot better. So we're watching closely the rulemaking on that, but our hope is that that's going to make lending even more favorable towards ESOPs. For worker co-ops, right, again, it's this kind of more direct and it's a less common model. Usually those worker shares are anywhere between like 2 and 10%. There's some things where you might have like a high human capital, low kind of fixed asset type firm where, everyone's fairly high wage and you might see the whole thing financed through member shares, but most cases we're looking at a fairly small percentage of the sale price being financed by that. Then you have kind of a seller's note. Again, usually I'd say there's some cases where, especially if the seller's going to be staying with the company and as a member, which sometimes happens for a while, that could be the majority or all of it. But generally a lender's going to want to see at least a quarter to a third, again, as that's kind of skin in the game. So there are specialized lenders like the Cooperative Fund of New England that are very familiar with the model and can make certain allowances around things like personal guarantees, which can get tricky when you have 20 co-owners. Who's going to guarantee? Can guarantees be allocated equitably. So oftentimes worker co-ops are wanting to sort of avoid the personal guarantee requirement that most small business owners are intimately familiar with. So some of these specialized lenders, like the Cooperative Fund of New England, are good partners for that, because they understand the trickiness and can be more flexible than a traditional bank. And then there's the option of kind of social investors, community raise. So if a company is kind of more of a B2C type thing, has lots of loyal customers, there's some great examples of companies converting to co-ops as kind of with, that sort of like broad-based, direct public offering type thing. So in the Vermont, there's Milk Money, Visbo, that sort of structure. And then also just kind of social investors who are interested in the mission and the idea of of cooperatives that are out there. That the Vermont State Employees Credit Union has an equity fund, that sort of thing. So thank you all for watching this. If you'd like to get in touch with Lynne, her info is on the screen here. And if you'd like to get in touch with the Vermont Employee Ownership Center to learn more about our work, you can info@veoc.org, go to our website. We also have our annual conference coming up on June 12th. And so definitely, and we do that every year. So if you're interested in kind of getting a deep dive into the employee ownership piece, that's a great opportunity. So thank you very much.